the Finance Ministry has just made an announcement that remember there were 34% tariffs on all US goods coming into China. That's now been increased to 84%.
President Trump is now promising a new 50% tariff on China, on top of the other new tariffs, which are on top of existing tariffs. Combined, this would make U.S. tariffs on imports from China a whopping 104%.
That includes a 104% tariff on China, which, by the way, has responded this morning by hiking their tariffs on U.S. goods to 84%. That is up from the previous 34%.
Let's return to our breaking news now, where China has announced 84% tariffs on American goods coming into China.
China, 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 China.
Trump in panic mode. China's bond threat and the trade war earthquake. Trump is in panic mode. But this time it's different. On April 9th, President Trump shocked the markets by suspending most of the tariffs imposed on U.S. trading partners for 90 days. Wall Street cheered. Stocks bounced. For a brief moment, it looked as if things were turning around. But then, China. Yes, China. While other trading partners benefited from the suspension, China was hit harder than ever. Instead of easing the pressure on all, Trump expanded tariffs on Chinese goods from 104% to an astounding 125%. In response, Beijing moved with lightning speed, imposing retaliatory tariffs of 84% on U.S. goods. And now, China is preparing its most powerful move yet, a so-called trade atomic bomb. Recent reports suggest that China is considering selling off its massive holdings of U.S. Treasury bonds, estimated between $900 billion and $1.1 trillion. This prospect has sent shockwaves through Washington. Wall Street is reeling, and the Trump administration is visibly panicking. This is not merely another trade dispute, it is financial warfare. For years, China has been one of the largest holders of U.S. Treasury debt. By using its trade surpluses to purchase American bonds, China helps stabilize its own currency and finance the U.S. current account deficit. This relationship epitomized global economic interdependence. But Trump's recent tariff aggression may have forced Beijing's hand. According to internal documents circulating on Chinese social media, the People's Bank of China has reportedly instructed major financial institutions to reduce their exposure to U.S. dollars. Some sources claim that Beijing has already begun offloading portions of its treasury holdings, quietly but deliberately. Experts are calling this move the nuclear option. Should China dump U.S. bonds, the consequences could be catastrophic. U.S. interest rates would spike, the dollar would weaken, inflation would surge, mortgage rates could soar, investment might collapse, and the U.S. economy could well tip into recession. Let's break down what's really at stake. U.S. Treasury bonds are considered the backbone of global finance and the world's safest investment. If China begins selling these bonds en masse, their prices would drop and yields would rise significantly, thereby increasing the cost for the U.S. government to borrow money. Imagine the ripple effect. As bond yields rise, interest rates across various sectors, from credit cards and student loans to home mortgages, would also increase, resulting in a slowdown in consumer spending and a contraction in business investment. Already, market indicators are showing signs of stress. Yields have started to spike and bond prices are slipping. All of this is unfolding even before China has made any comprehensive move. Some economists argue that China's threat might simply be a bluff, a strategic gesture meant to exert pressure without actual harm. After all, dumping U.S. bonds entirely would also devalue those that China continues to hold, making it a mutually destructive act. However, Beijing may not need to sell all its bonds to make its point. Even a gradual reduction, a few $billion per day, might be enough to instill panic in the markets. In fact, merely signaling its intent to sell could push yields higher and unsettle global investors. Moreover, China might be playing a longer game by shifting away from dollar-denominated assets, thereby promoting the global adoption of its own digital currency increasing trade in local currencies and reducing its dependency on the U.S. financial system. This move is not merely reactive. It could signal a revolutionary shift in global finance. Back in Washington, the reaction has been chaotic. On one hand, Trump continues to assert, "We will win the trade war." Yet, on the other, voices within Congress and among Treasury officials are expressing deep concern. Some Republicans are warning that continuing the tariff war may be akin to shooting ourselves in the foot. Should China actually follow through on its threat, the resulting scenario could bring about a sharp recession in the U.S., characterized by rising interest rates, falling investments, and a significant drop in consumer confidence. The bond market is already exhibiting what some analysts describe as a bond-centered earthquake. Investors who once regarded U.S. Treasuries as the ultimate safe haven are now fleeing in droves. The shock is palpable across global markets. This isn't only about domestic repercussions. The implications extend globally. Countries like Japan, South Korea, and many European nations also hold large quantities of U.S. debt. If China initiates a massive sell-off, these nations may be forced to react, either out of fear or necessity, thereby triggering a chain reaction across the entire global bond market. Capital flows could shift drastically, risk premiums could rise, and emerging markets might suffer collateral damage. Some experts fear that this situation could precipitate a crisis reminiscent of 2008, but on an even larger scale. On social media, doomsday scenarios abound. Many compare the potential collapse to a financial earthquake that could shake the very foundations of the global economy. Meanwhile, the Trump administration is left grappling with a critical question. Is Trump bluffing, or is he truly cornered? The president has repeatedly asserted that he intends to negotiate a deal, that we're waiting for their phone call, referring implicitly to China. Yet Beijing's position remains firm. Lower the tariffs first. Trump's unpredictable tactics, once a hallmark of his strategy, now risk destabilizing not just the trade balance, but the entire financial system. The bigger question remains, what is Beijing's plan? It is unlikely that China would unload its entire Treasury bond portfolio in one fell swoop, as that would be self-damaging. Instead, a measured, gradual sell-off might serve as a powerful signal to the U.S. markets, inducing sufficient anxiety to force a political and economic recalibration. Another possibility is that China could simply stop buying new U.S. bonds. As existing bonds mature, if China chooses not to reinvest its money, it would gradually erode demand for U.S. debt, a silent protest that could have profound consequences over time. This ties into another critical aspect of the unfolding situation, the future of the U.S. dollar itself. China's strategy may extend beyond short-term market turbulence. By diversifying its reserves away from the dollar and promoting the digital yuan, Beijing is aiming to diminish global reliance on the U.S. currency. This move would not only reduce China's vulnerability to U.S. sanctions, but might also, in the long run, undermine the dollar's status as the world's reserve currency. Meanwhile, the U.S. faces a perilous predicament. The repercussions of a bond sell-off or reduced dollar purchases would not remain isolated within its borders. A weakening dollar combined with rising interest rates could lead to a dramatic increase in borrowing costs, affecting everything from consumer loans to corporate debt. This, in turn, could slow economic growth, trigger layoffs, and even bring on a recession. The situation is especially dire given that investor confidence in U.S. Treasuries, a cornerstone of global financial security, is wavering. The unfolding drama has led to a high-stakes standoff between the United States and China. Both sides appear to be playing their final cards. Trump's aggressive tariff policies have not only strained relations, but also exposed vulnerabilities within the U.S. financial system. On the other hand, China's willingness to threaten a large-scale bond sell-off underscores its readiness to shift global financial power away from Washington. But what are the possible outcomes? Analysts suggest three primary scenarios. The first is a diplomatic reset, in which both sides come to the negotiation table lower tariffs, and commit to new trade terms. In this optimistic scenario, the threat of a bond sell-off is withdrawn and markets gradually stabilize. The second scenario is one of financial escalation. Here, China releases a significant portion of its U.S. bonds, pushing yields higher and forcing the U.S. into rapid damage control. This would likely result in heightened market volatility, investor panic, and possibly a severe recession. Finally, the worst-case scenario is a systemic crisis. In this dire outcome, both sides double down on their current stances. The trade war intensifies, the bond market becomes unanchored, and investor confidence plunges. Global central banks are forced into emergency measures, and the recovery, if it comes at all, is slow and painful. So, who will blink first? Will Trump relent under the mounting pressure, or will Beijing's calculated financial aggression force a new global economic order? While some observers believe that any significant sale of U.S. bonds by China would be a bluff, the threat alone has already rattled markets. In the corridors of power in Washington, there is growing concern that if even a fraction of China's vast holdings is dumped, the subsequent rise in interest rates and inflationary pressures could lead to a recession. This is not merely an abstract risk. It is a very real possibility that could impact millions of Americans, and indeed people around the globe. Complicating matters further is the broader geopolitical context. The U.S. and China have long been locked in a high-stakes trade war, but this development represents a new front, one that targets the very underpinnings of the global financial system. Beyond the immediate economic implications, there is also a strategic element to consider. The aggressive posture taken by both sides could signal a permanent shift in the international order. Should China succeed in gradually reducing its reliance on the U.S. dollar, or even coercing a significant sell-off of U.S. bonds, it would mark a turning point in global finance, a move that could empower China and weaken U.S. influence worldwide. At the same time, however, such a course is fraught with risks for Beijing as well. A massive, uncontrolled sell-off could cause global markets to spiral, which might eventually hurt China's own economy. The irony is palpable. In trying to weaken the U.S., China could end up undermining its own financial security. And yet, both nations appear to be locked into this dangerous game. With trade tensions at an all-time high and investor sentiment wavering, the world watches with bated breath. In the words of some market analysts, this is the moment when bonds become weapons, a scenario that could redefine global economic power. The situation is reminiscent of past financial crises, yet it is fueled by entirely new dynamics. Here, political brinkmanship, aggressive tariff policies, and bold financial maneuvers converge to create a perfect storm. The overarching question remains: can diplomacy prevail in such a high-stakes environment, or are we witnessing the early stages of a global financial collapse? As we approach the fall of 2025, uncertainty looms large. Some experts predict that the U.S. could face a recession if investor panic continues and yields keep rising. Others warn that even a partial sell-off of Chinese-held U.S. bonds could trigger a cascade of adverse economic events, spanning from a devaluation of the dollar to severe disruptions in global trade. Amidst this turbulent backdrop, Trump's administration continues to project confidence, promising that the U.S. will prevail. Yet behind closed doors, many are questioning whether the current strategy is sustainable. Some members of Congress are even beginning to openly criticize the relentless use of tariffs, suggesting that this approach may ultimately backfire. The combination of aggressive tariffs, political posturing, and the potential for a massive bond sell-off has turned the trade war into an all-out financial standoff. With the world's two biggest economies at a tense crossroads, every move is being scrutinized, and every decision could have far-reaching consequences. The narrative on social media is intense. Every analyst, every pundit, and every investor seems to be weighing in on the question: is this a calculated bluff by China, or is it the prelude to a full-blown financial crisis? There are even comparisons being drawn to historical turning points, where aggressive protectionist policies triggered widespread economic upheaval. Some commentators note that the current situation mirrors, in some respects, the protectionism of the 1930s, a period that led directly to the Great Depression. While the parallels may not be perfect, the warning is clear. Unchecked economic brinksmanship can lead to disaster. Meanwhile, Beijing's actions are not limited solely to the bond market. Recent reports indicate that in addition to the potential sell-off, China has also instructed its major banks to curb new dollar purchases. This quiet but significant move could further diminish demand for U.S. bonds, compounding the pressure on the American financial system. The message from Beijing is unmistakable. The era of unchallenged U.S. dominance in global finance may be coming to an end. In response, U.S. officials are caught in a dilemma. On the one hand, they need to maintain confidence in the Treasury market, a cornerstone of international finance. On the other hand, they must contend with the very real possibility that China's calculated moves could undermine that confidence. The coming months will be critical. As negotiations continue and as the global bond market reacts to every new development, there is a growing sense that we are on the cusp of something unprecedented. Whether it is a temporary setback or the beginning of a long-term transformation, one thing is clear: the stakes could not be higher. The interplay between tariffs, bond markets, and global economic confidence has created a situation where even small missteps could trigger a chain reaction of catastrophic proportions. So, as we watch this high-stakes standoff unfold, the question remains, who will blink first? Will Trump's aggressive trade policies force a change in Beijing's strategy? Or will China's bold moves compel the U.S. to reconsider its approach? Perhaps the answer lies somewhere in between, a precarious balance where diplomacy and economic imperatives meet. What is certain, however, is that the global economy stands on the edge of a precipice. Investors around the world are bracing for impact, and central banks are preparing for turbulence. In these uncertain times, all eyes are on Washington and Beijing, waiting to see how this crisis will unfold. The stakes extend far beyond mere trade figures or bond yields. They touch on the very essence of global economic stability. With the threat of a recession looming on the horizon and the potential for dramatic shifts in financial power, the decisions made in the coming days will reverberate across continents. In conclusion, the U.S. China trade war has evolved into a high-stakes financial chess match. Aggressive tariff policies, investor panic, and the looming possibility of a massive sell-off of U.S. Treasury bonds have transformed the landscape. Will diplomacy prevail, or is the world on the brink of a financial collapse? As market watchers, political leaders, and everyday citizens alike hold their breath, one thing is clear: when bonds become weapons, no one is safe. Don't forget to like, subscribe, and hit that notification bell so you never miss an update on this developing story. Leave a comment below. Do you think China will actually sell its U.S. bonds? Or is this just a strategic bluff? Stay tuned as we continue to follow every twist and turn in this unfolding global drama. In the end, the battle is not just about tariffs or bonds. It's about the future of global economic power. The tense standoff between the world's two largest economies is a stark reminder that in today's interdependent world, every decision has far-reaching consequences. As Trump insists on a hard line and China prepares its final trump card, the global financial system braces for what could be the most dramatic shock in decades. The question remains, who will blink first in this high-stakes game of economic brinkmanship? The answer may determine the fate of not only the U.S. economy, but also the entire global financial order. Thank you for watching, and remember, stay informed, stay cautious, and as always, we'll be here to break down the news as it happens.